Hey, good morning. This is Mayor Valensky with Driving Markets. Okay, let's kick off. We've got a busy week ahead, but before we go into the week ahead, I just want to focus on where we're at with the markets. The markets have been rallying recently, okay? So they've been rallying on the back of the AI and ChatGPT. Okay, AI, artificial intelligence. Now what's happened is that the market's gone into a bit of a frenzy and also a bit of a FOMO position, fear of missing out. So you've got a lot of traders, a lot of investors, a lot of companies are piling into this technology on the hope that this is going to save the markets and pull them up or push them up to new highs and create a bullish environment and a bull market as far as stock markets are concerned. However, it's not going to happen. This has all the ingredients of the dot-com crash of 2000 and the banking crisis of 2008, 9, 10. And we'll go into that in a little more detail. The dot-com crash was previous to the dot-com crash up to 96, 97, 98. There was a massive rush into technology. Those of you who are over the age of 30, 35 will remember the dot-com crash. Now what happened was there was then hysteria or frenzy to just get involved in anything that had .com at the end of it, even though the fundamental business of that proposal or that startup was not strong enough in order to produce revenue. There was a lot of movement, a lot of investors and hedge funds moved into the .com and just poured money into it. They gave them money for nothing, and we're talking millions. Small companies were given £1 to 10 million pounds or dollars, and they just burnt it. The burn rate was unbelievable, and they just spent the money left, right, and center. A bit like the startups these days, or the SPACs, the special purpose acquisition companies that were also valued recently of tens of billions valuations, but they hadn't produced 1 cent or 1 penny in profit, and those SPACs have gone bust by about 98% or dropped by 98%. Some of them have actually gone bust. Very, very similar mentality where there is a lack of diligence, a lack of due diligence, and a lack of accountability by the actual holding .com or the holding technology company to justify where their valuation is and to justify where the money is actually going. So we're very much repeating that type of atmosphere, that type of environment where there's a lot of startups or a lot of AI companies or semiconductors or companies that have not produced profits, whereby they're being sought after and the shares are going up and up and up as if creating a bull market. But all of that is rallying for one end, for one particular purpose or one particular aim. It's going to end up falling. Now, the reason why it's rallying is because the banks themselves and the investment managers and the hedge funds have an interest in pumping up this stock. They want to pump it up to such a level to give them huge amounts of profits that they've lost out on back in 22 as a result of the stock market turning down, and the small individual trader or investor is going to end up paying the price on those particular investments. So it's very much a pump and dump scenario, and we're going to have a repetition of what we had back into the year 2000 with the dot-com crash, and that's going to happen now in 2023 and 2024. You're going to have another technology crash over that period of time. What we're talking about in terms of numbers, probably talking about at least a 25% to 35% drop in the technology sector, whether it's the NASDAQ or whether it's the DAX, because the DAX is heavily technology orientated. Not so much the FTSE, because FTSE is more defensive stocks, but anywhere technology, you're going to have a significant drop, especially as liquidity becomes tighter and becomes less available, excuse me, with rising interest rates. Then that's also going to impact the availability and the ability of these investment fund managers and these hedge fund managers to take a longer term investment when it comes to these technology stocks. So you can expect a significant downturn in the technology sector. It's well overpriced. It's got no reason to be there. Nvidia, for example, is running at 200 times earnings, just too high. Apple's far too high. Also, Meta's too high. Tesla's been on a non-stop run for the last 14, 15 days. Looks like there should be some profit taking there. So keep an eye on the technology sector. Why did I say it's similar to the 2008-2009 banking crisis? Because what you've got at the moment, also you've got a big cover up. The tier 1 banks are covering up the tier 2 banks. The Fed, the US Treasury, doesn't really want to admit there's a major banking crisis in the US. We're talking about a regional banking crisis. There's a lot of withdrawals going on, and that money is being pulled out and put it into CD, certificates of deposits, or into treasuries, or into other interest-bearing guaranteed bonds. It's moving out of the regional banks and into other investments. In addition to that, you've got an uptick in defaults in the US, whether it's on credit cards or whether it's on car loans. Those are the first two things. Credit cards, car loans, those are the first two things that generally fall behind on the payments, because those are the things that the consumer feels as though in his mind he can afford to be later on and concentrate more on the mortgage and his business or his other bills, food and energy he has to pay for. So there's been an uptick in the defaults on credit cards or late payments on credit cards and car loans, which would mean that there's going to be effectively late payments and defaults coming in on commercial loans, which already is, and on residential property and other types of facilities that the consumer gets from the bank. Now that is money that the bank has to find. Remember last week I said twice that Westfield shopping mall in San Francisco effectively has gone bust, and the commercial loan there is gone into defaults. That's a huge amount of money gone out of the banking system. These regional banks that are dependent on the small business paying their bills, the small business is now having serious difficulties in having the turnover that they have, because they feel as though there's a recession out there. The small business, we're not talking about official recession, we're talking about the unofficial recession, where the small business is impacted more than the big business. And the regional banks are geared towards the small businesses, and those small businesses are suffering. So there is a regional bank crisis that is brewing at the moment, being hidden or covered up by tier one banks and the US and by the US Treasury and the Fed. So you're going to have an impact of the US, of the second tier banks going bust or having difficulties over the coming months. So just be aware that is happening, and that's what's likely to cause another banking crisis, another downturn in stock markets as time goes on over the summer months. There's about $1 trillion waiting to be wiped off debt over the next few months, as more and more companies are going bust and filing for bankruptcy in the US. This week we've got Jerome Powell giving his testimony to Congress. You've also got UK interest rates likely to rise on Thursday by 25 basis points. You've got inflation numbers out in Europe, and on Wednesday, which are the PPI, which is manufacturing index, it's manufacturing inflation. What else you got? You've got Fred Waller giving a speech. He's one of the presidents of the Fed. Then you've got Friday, you've got the PMI index, Purchasing Managers Index. That's also a sentiment report to see where they're at regarding that in the US. There's national holiday tomorrow, Juneteenth holiday in the US on Monday, so the market's going to be closed, and that's more or less it. You can also buy my book on Amazon. You can check me out and subscribe, share, comment. Any help I can give you at all regarding input, happy to help. Mayor Valensky with Driving Markets. Remember, anything said in this piece is an opinion only. Catch you later.